Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research at SFO. So the past week saw markets weighed down by rising tensions in the Middle East, inflation pressures and interest rate concerns. Investors kept a close eye on the US third quarter earnings to gauge corporate health, while central banks around the world adopted a more cautious approach to inflation persisting and economic growth signals remaining mixed. So before we move into markets and macro, let's just check in on the current situation in the Middle East. Clashes between Israel and Hezbollah intensified during the week, driving a lot of volatility in energy markets. Oil prices fluctuated throughout the week, reflecting fears of potential supply disruptions. But by the end of the week, crude did stabilize, but concerns about a broader conflict did, however, remain. Gold prices also rose to $2,750 an ounce as investors sought safe haven assets amid the geopolitical uncertainty. However, oil tumbled more than 6% at the start of the week after Israeli strikes against targets in Iran avoided crude facilities, raising the prospect for easing hostilities in the region. Then moving into markets and macro, starting in the US, the S&P 500 ended the week slightly lower after 6 consecutive weeks of gains, as rising treasury yields impacted sentiment. Large cap stocks held firm, with tech names including Tesla leading the gains. Tesla surged by 22% during the week, its biggest jump in over a decade, following a strong earnings report that forecast a 20 to 30% rise in vehicle sales by 2025. Apple, on the other hand, dragged on markets as analysts downgraded the stock due to the weaker iPhone 16 sales forecasts. On the macro side, the Federal Reserve's Beige Book, which provides a snapshot of economic conditions, pointed to moderate growth and easing inflation. However, the 10-year U.S. Treasury yield still rose to 4.2%, reflecting market skepticism about aggressive rate cuts in the coming months. Then moving across the pond to the Eurozone and the UK, European markets faced some pressure with the Stock 600 index down by 1.18%, as economic activity in the Eurozone remained weak. October's composite PMI held at 49.7, signaling ongoing contraction, especially in France and in Germany. ECB policymakers are, however, divided on the pace and timing of rate cuts, with some urging caution and others warning against falling behind inflation targets. In the UK, business activity hit an 11-month low, with consumer confidence dipping amid concerns about possible tax hikes. Preliminary data did show the composite PMI falling to 51.7 from 52.6 in September. This, however, remains in expansionary territory. Then moving further east to the Asia-Pacific markets, Japanese markets also fell, with the Nikkei down 2.74% as investors remain cautious ahead of Sunday's general election. The yen also weakened to 151 against the dollar, reflecting a strong dollar and uncertainty about Japan's inflation trajectory. The Tokyo Core CPI index rose by 1.8% in October, slightly above expectations but below September's 2%, driven by the return of energy subsidies. And moving further south, in China, markets saw some modest gains following new stimulus measures. The Shanghai Composite Index rose by 1.17%, however the Hang Seng lost 1.03%, as investors remained wary about the economic recovery in the region. The People's Bank of China also injected some more stimulus into the financial system while holding lending rates steady. And then moving back home, South Africa's inflation fell to 3.8% in September. This is below the 4% number for the first time in over 3 years, reinforcing expectations of a rate cut in November. The All-Share Index ended flat for the week, with a 1.7% rise in resource stocks offsetting the losses in the financial sector. The rand weakened slightly as the US dollar strengthened during the week, closing at 17.66 to the dollar. And then just looking at the week ahead, so the big focus remains on major US earnings numbers, including this week we'll see some reports from big tech companies like Apple and Amazon. On the macroeconomics front, in the US, the focus will be on the employment numbers as well as Q3 GDP growth numbers out on Thursday. In the Eurozone, we'll also see a string of inflation numbers released across the region. There will also be some PMI numbers out of China, which will be a key focus for the market, while locally the attention will turn to Finance Minister Enoch Godongwana's medium-term budget speech on Wednesday. And then, as always, we'd like to end off the week with an interesting investment conversation we discussed during the week, and the talk was all about the medium-term budget speech. So since the recent elections, sentiment in the country has been very upbeat, and the budget is expected to reflect that optimism even further. The government's latest target of 3% economic growth in 2025 is significantly higher than the previous forecast of 1.7%, and achieving this would definitely greatly improve economic indicators, but visible progress is needed within at least a year to sustain the confidence. So if key issues are addressed, including securing a stable power supply and fixing logistical challenges, the country could achieve high growth starting from a very low base. Success in these areas would not only help with budget management, but also boost job creation, which is crucial for the economic growth we want to see. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation.